Something fundamental is breaking, quietly, methodically, without headlines screaming panic. The world's most trusted asset is no longer being trusted, not because of a single crisis, not because of a single speech, but because confidence itself is eroding behind closed doors. Global investors are making a decision that could redefine power, currency, and wealth for the next generation. They are not asking if the system will change. They are positioning for when it finally does, and the shift isn't loud, it's strategic, it's calculated, and once it becomes obvious, it may already be too late, because when the bond market breaks, everything else follows. But here's the part no one is saying out loud. Welcome to Boring Currency Index. Now, before we begin, if you've seen a few cycles, if you've watched markets rise and fall more than once, then you already know wisdom comes from preparation, not speed. So take a moment, subscribe to the channel, not for noise, but for clarity, and tell us something important. From which country are you watching this unfold? For decades, U.S. Treasuries were treated as the safest asset in the world. Governments held them, pension funds relied on them, banks used them as collateral. In every crisis, investors ran toward U.S. bonds, not away from them. They were seen as risk-free, not because the numbers always looked perfect, but because trust in the system was absolute. That trust is now weakening. It did not break in a single moment. There was no dramatic announcement or sudden default. Instead, the damage came slowly through repeated signals that were easy to ignore at first. Large deficits became normal, debt ceilings turned into political theater, emergency spending became permanent policy. Over time, investors stopped asking whether the U.S. could borrow and started asking at what cost. They noticed that debt issuance kept growing faster than the economy itself. Each year, more treasuries had to be sold just to keep the system running. Foreign buyers, once eager, began to reduce their exposure quietly. Not because yields were too low, but because risk was no longer being priced honestly. In bond markets, confidence matters more than headlines. When investors trust a government, they accept low returns. When that trust fades, yields rise. That is exactly what started to happen. U.S. yields became volatile. Auctions showed weaker demand. The cost of borrowing began to climb at the worst possible time. This was not just a financial issue, it was a structural one. The United States relies heavily on debt to fund its economy. High stock prices, corporate expansion, and government programs all depend on stable financing conditions. When bond yields rise, everything becomes more expensive: homes, factories, technology, and even basic government operations. Global investors understood this risk early. They saw a system where political decisions directly affected monetary stability. Sanctions were used as weapons. Trade became unpredictable. Long-term planning became harder. For institutions managing retirement money or national reserves, unpredictability is unacceptable. So they adjusted. They did not rush for the exits. Instead, they shortened duration, reduced exposure, and began searching for alternatives. This shift was not emotional. It was calculated. It reflected a simple conclusion. U.S. Treasuries were no longer politically neutral, and neutrality is essential for a global reserve asset. This was the fracture point. Not a collapse yet, but a clear warning. When trust begins to crack in the bond market, the consequences do not stay contained. They spread quietly, steadily, and then all at once. And that is when the real story begins. When large investors lose confidence, they do not panic. They do not rush to sell everything at once. Panic is expensive. Instead, they move slowly, quietly, and with precision. This is how the exit from U.S. Treasuries truly began, not with headlines, but with subtle repositioning. They understood something important. Selling U.S. bonds loudly would hurt their own portfolios. It would push yields higher and prices lower. So instead of announcing their concerns, they adjusted their behavior. They bought fewer long-term bonds. They rolled over maturing debt into shorter maturities. Some stopped reinvesting altogether. To an untrained eye, nothing looked wrong. But behind the scenes, the structure of demand was changing. Central banks, pension funds, and sovereign wealth funds started to think differently about risk. Yield was no longer the main concern. Stability was, predictability was, and above all, political neutrality mattered more than ever. They asked hard questions. What happens if U.S. deficits keep expanding? What happens if inflation returns and rates stay high? What happens if debt is monetized instead of controlled? These were not theoretical debates. These were real portfolio risks. Currency exposure also became a key issue. U.S. debt is not just about interest payments. It is also a bet on the dollar. When policy becomes erratic, currency risk rises. Investors noticed that the dollar was no longer a one-way bet. Volatility increased. Hedging costs grew. That made treasuries less attractive, even at higher yields. Another factor mattered deeply: trust. The U.S. financial system had long been seen as rules-based, but sudden policy shifts, trade threats, and financial sanctions created uncertainty. Investors realized that access to their assets could depend on politics, not contracts. For long-term capital, this was unacceptable. so diversification became the strategy. They did not abandon the US overnight. Instead, they reduced dependence. They looked for assets that were not tied to US political cycles. They spread risk across currencies, regions, and systems. This was not anti-American. It was defensive. This is how capital truly moves in the modern world. Quietly, methodically, without emotion. By the time the shift becomes visible in data, it is usually already advanced. The silent exit does not announce itself. It only leaves clues behind. Lower demand, higher yields, and growing instability. And as these clues accumulate, one question becomes unavoidable. If smart money is preparing for a different future, should everyone else be paying attention? For a long time, there was no real alternative to US Treasuries. Investors might complain, but in the end, they always returned. The market was deep, liquid, and supported by the world's dominant currency. That reality is now changing, not because the United States disappeared, but because another option quietly matured. China did not announce a challenge. It did not demand trust. It simply offered stability. As global investors reduced their reliance on US debt, they began to explore assets that could balance risk rather than replace one system with another. This is where China's RMB-denominated bonds entered the picture. They were not designed to shock the market. They were designed to absorb capital looking for predictability. These bonds operate under a different logic. China's policy system is rigid, but it is consistent. Rules change slowly, currency movements are managed carefully. For long-term investors, this kind of control can be more attractive than constant policy swings. It allows planning, it allows modeling, it reduces surprise. Another factor mattered: neutrality. Unlike US assets, Chinese RMB bonds have not been used as political weapons. Investors are not worried about sudden freezes or forced restrictions. The relationship is transactional. Capital flows in, returns flow out. That simplicity is powerful in uncertain times. Europe played a key role in this shift. Through offshore clearing systems, RMB bonds became accessible without forcing investors to move capital into China directly. This reduced operational risk while maintaining exposure to a different currency. For pension funds and insurers, this structure was critical. Currency performance also changed perceptions. The RMB did not collapse. It remained relatively stable and at times strengthened against the dollar. This challenged old assumptions. Investors began to see RMB exposure not as a gamble, but as a hedge. Importantly, this was not a mass migration. It was incremental. Small allocations at first, test positions, then gradual expansion. This is how serious capital behaves. It does not chase trends, it builds positions over time. For China, the benefit was clear. Each bond issued increased the international use of its currency. Each buyer reduced reliance on the dollar, even slightly. Over time, these small moves added up. This was not about replacing one empire with another, it was about optionality, about having choices in a world where certainty is fading. And once investors discover they have options, they rarely return to dependence. When global investors pull back, even slowly, the consequences do not remain confined to bond markets. They move outward, touching every part of the economy. For the United States, this shift carries a unique risk because the system is built on continuous and affordable borrowing. As foreign demand for US Treasuries weakens, yields rise. Higher yields mean higher costs. The government pays more to finance its deficits. Companies pay more to borrow. Households face higher mortgage and loan rates. What once felt manageable becomes restrictive. This is especially dangerous for a highly financialized economy. In the United States, asset prices drive behavior. Rising stock markets support spending, hiring, and investment. But those asset prices depend on cheap and stable financing. When bond yields climb, valuations come under pressure. Confidence weakens, investment slows. Technology investment is one of the first areas to feel the strain. Large projects require long-term funding and predictable costs. When borrowing becomes expensive, expansion plans are delayed or canceled. This affects not just companies, but entire supply chains and job markets. The government faces its own dilemma. It can cut spending, which risks slowing the economy further, or it can continue borrowing at higher costs, which worsens the debt problem. A third option exists, monetizing the debt through the central bank, but this carries inflation risk and damages credibility even more. Domestic investors cannot easily replace foreign buyers. U.S. households and institutions already carry heavy exposure to domestic assets. Forcing them to absorb more government debt concentrates risk instead of reducing it. Over time, this weakens financial resilience. What makes this moment different is awareness. Investors now understand that political decisions and financial outcomes are deeply linked. Threats, sanctions, and trade pressure may feel powerful in the short term, but they come with long-term costs. Capital remembers how it is treated. As alternatives grow, dependence shrinks. The dollar does not collapse overnight. Treasuries do not disappear, but their dominance slowly erodes. And erosion, once it starts, is hard to reverse. For decision makers, this is the warning. Financial leadership is not guaranteed. It is earned through stability, predictability, and restraint. When those qualities fade, capital moves on. The bond market does not shout, it signals. And those who ignore the signal often realize the truth only after the cost has already been paid.